And welcome back to Sacramento Smooth Jazz. This is the time for our Clear Talk Financial series here, right here on Sacramento Smooth Jazz. Every day we do this. Now you hear it every day, 9 a.m. and again at 5 p.m. with John Nunes, President and CEO of Fortis Insurance Solutions. And why do we do this? Why do we stop the music for 5 to 7 minutes to give you financial insight? Because it's important. And many of you have been asking a lot of questions, and we've been talking about Roth conversions. Well, John has, and I've been asking him some questions, so I'm learning alongside with you. You're going to also have opportunity to get a free guide on how to schedule a no-cost appointment today. So this is no hype, no pressure, and definitely no financial noise. Just straight, thoughtful conversations designed to help you feel informed and comfortable and more confident about your financial road ahead. John, welcome back to Clear Talk. How's your day going?
Michael, the day couldn't go any better. I'm just glad to be here with you today.
I'm glad you're here as well. So we've been talking about Roth conversions, and we were going to end it off part 3, but yet we had a number of questions come in. So, well, we got to continue this. So I want to continue with this line of discussion here on the Roth conversions. And we had some questions about, people want to know how much should they convert? How do they decide? Things of that nature. And listeners, I want to let you know, you can get a free guide after this, and we'll tell you how to do that. So John, in the last segment, which was part 3, we ended with the idea that retirement is lived through income, not account statements. And listeners have been asking for more details on that. So let's continue with the question most people eventually ask. How much should someone actually convert when it comes to this topic?
Well, Michael, that is the right next question, because once people begin to understand the basic idea of what a Roth conversion is, the one thing that they often do is they jump too quickly to a dollar amount. At this point, when you're doing the conversion, that dollar amount, it should not be guessed. It should be tested. Now, a person may convert too little, and by doing so, they may miss an opportunity, or they could possibly convert too much, which is going to create a potential tax problem. It could also produce a Medicare problem or even a liquidity problem. So the goal here for everybody is to convert only what makes sense within their retirement plan.
Okay, yeah, I get that. So when someone hears that Roth money may provide tax-free withdrawals, which of course is appealing to everybody, it can be tempting to convert a large amount of money right away. So why can the conversion amount itself create problems?
Well, because every dollar that's converted is generally added to your taxable income for that year. Now, what that means is that that amount can actually affect your tax bracket, potentially affect your cash flow, maybe even your Medicare-related premiums, and also how much liquidity money remains available after that tax bill has been paid. So a Roth conversion can be a smart move, but even a smart move can become expensive if the amount is not controlled. And that's the whole point of our conversation today. And that's why I call this whole thing a planning decision, not an emotional decision.
Ah, yes, indeed. Yeah, because, one thing we all know is that, people are emotional. Money isn't. Rather than asking whether to convert everything or nothing, how should a retiree think about partial conversions over several tax years?
Well, Michael, in many cases, a partial conversion, it may be more thoughtful, because what that does, it allows the person to spread the tax impact over time. And so the idea is not to force all of the money into a Roth as fast as possible, but rather the idea is to look at the available tax window, decide how much room may exist in a reasonable tax bracket, and then obviously repeat that review every year by year. Because remember, retirement is not a one tax year. It's a multi-year income and tax picture.
So, John, when you say the conversion needs guardrails, what are the tax bracket and income thresholds you want people to review before they move money?
Well, Michael, the guardrails start with current taxable income, expected income for the year, deductions, Social Security taxation, capital gains, pension income, RMD exposure, and all Medicare-related thresholds. Now, this is where a tax professional becomes important, because I can help coordinate the retirement income strategy. But if you're looking at the exact tax calculation, that should be reviewed with a CPA or a tax preparer, because the goal here is to avoid accidentally pushing the client into a higher cost zone that could have been planned around.
Now, one listener asked whether it matters where the tax payment comes from. And that seems like a detail people might overlook. How important is that part of the decision?
Yeah, Michael, it is very important because if a person has any type of outside non-retirement money to help pay that tax bill, what that does, it helps preserve more of the converted amount that's inside the Roth. But if they have to use those IRA dollars to pay those taxes, what happens is they reduce the money that remains invested for retirement. And depending on their personal situation, that could create other complications. So a conversation should not leave the retiree cash poor because taxes matter, but what matters the most is liquidity.
Now, how does the purpose of the Roth dollars change the decision if money is for near-term income versus long-term tax flexibility or legacy?
Well, the purpose matters because Roth money usually needs time to work. Now, if someone plans to use that converted money immediately for living expenses, that's going to change the entire conversation. But if the purpose here is for long-term tax flexibility or future supplemental income, spousal protection, or even legacy planning, that Roth may eventually have a different role. Now, this goes back to the premise that every dollar needs a job, and the Roth account shouldn't just exist. It needs to have a defined purpose.
So before someone approves a conversion, and we talked about the stress test before, several episodes ago, what does a real-world stress test look like so they're not surprised next tax season?
Well, a good stress test is going to do multiple things, Michael. First of all, what it's going to do, it's going to review the expected federal and state tax impact, which is very important. Also, possible Medicare premium impacts, how that tax bill is going to be paid, how much cash is going to be staying available for you. That's where liquidity comes in, whether the retirement income floor is secure, and what happens if the market is down during that same period. I also want to know whether that conversation helps reduce any type of future tax pressure, or if it just simply creates a tax bill today with really no long-term clear benefit. That's the difference between planning and guessing.
For listeners who now understand, John, the amount that has to be planned and not guessed, we get that. What should they do next, and where are we going in this additional segment?
Well, the first thing I would tell them is slow down and get your numbers reviewed. You can visit our website at fortisinsuranceSolutions.com/before you convert. And you can actually request a free guide that we've made available that's called Before You Convert. And if appropriate, if you want to go a little more into detail, you can actually schedule a retirement income strategy review with us. So we can look at the tax picture, take a look at your income picture, and the purpose of all of this money together. Now, in part 5, we're going to bring all of this together, and we're going to talk about how your Roth dollars, your traditional IRA dollars, cash reserves, annuity income, and your legacy goals all should work as one coordinated retirement plan.
Ladies and gentlemen, John Nunes, Fortis Insurance Solutions. I've made it really simple for you to get to that guide. If you're on our website streaming right now at sacsmoothjazz.fm, I want you to scroll down until you see a copy of that picture of the conversion guide. And you see that, just press that, take you right over to Fortis Insurance Solution where you can get that booklet right away. Now, John, tell them how they can contact you by phone if they choose to do that.
Yeah, they can reach me, Michael, at 1-800-900-3150. That's 1-800-900-3150.
Excellent. Really appreciate you, as always, being here for the Clear Talk Financial Series segments to help our listeners just get another level of understanding concerning their finances. Appreciate you, John. Thank you for joining us.
Always a pleasure, Michael. Thanks for having me.
More than welcome. Ladies and gentlemen, this is Sacramento Smooth Jazz, your escape from the noise.